Welcome to Monster Invest. I'm Daniel. If you are listening to this right now, chances are you are doing something active. Maybe you are commuting to work, sitting in traffic, watching the brake lights in front of you turn red. Maybe you are at the gym, lifting weights, feeling the burn. Or maybe you are sitting at a desk, staring at a spreadsheet, trading your precious hours for a paycheck. We are taught from a very young age, by our parents, our teachers, and society, that money is a direct result of sweat. You work an hour, you get paid for an hour. You stop working, the money stops flowing. It's a linear equation. It is a transaction. And quite frankly, for most people, it is a trap. But today, we are going to break that equation. We are going to smash the idea that time must equal money. We are going to talk about the only way to truly detach your existence from your income. We are talking about building a financial machine that breathes, grows, and pays you, even while you sleep, even while you are on vacation, and even when you eventually decide to stop working forever. Today, we are doing a deep dive into the holy grail of personal finance, how to create passive income through investing. This isn't going to be a quick 5-minute tip. We aren't going to talk about side hustles that are actually just second jobs. We are going to deconstruct the entire philosophy, the specific strategies, the hidden risks, and the step-by-step execution. So settle in, this is the blueprint. Let me start with a story. It's a classic parable that perfectly sets the stage for everything we will discuss today. It is the story of Pablo and Bruno. Pablo and Bruno lived in a small, remote village. The village had a problem. It needed water, and the nearest spring was on top of a steep mountain nearby. The village elder hired both men to bring water down to the village square. Bruno was strong, he was built like an ox. He grabbed 2 heavy steel buckets, hiked up the mountain, filled them, and carried them back down. He did this all day, every day. Up and down, up and down. He was paid for every bucket he delivered. If he wanted more money, he simply made more trips. He bought a bigger house, ate better food, and was the hero of the local tavern. He was the definition of hustle. But every morning he woke up with a sore back, blistered hands, and a sense of dread. He knew deep down that the day his strength gave out, due to injury or age, his income would hit zero instantly. Pablo was different. He was smaller, not as strong. He carried buckets for part of the day to pay his bills, but he spent his evenings and weekends doing something else. The villagers thought he was crazy. He started digging a ditch. He was building a pipeline. For months, Pablo made less money than Bruno. His hands were bloody from digging through rocks and roots. The villagers laughed at him. They called him Pablo the Pipeline Man. He was working hard with no immediate reward. It was brutal. It was lonely. But fast forward 2 years. Bruno is exhausted, hunched over, and aging rapidly. The sparkle is gone from his eyes. But Pablo finished his pipeline. He turned a valve, and clean, fresh water rushed from the mountain directly into the village tank. Pablo didn't have to carry a single bucket ever again. He got paid for every gallon of water that flowed through the pipeline while he ate, while he slept, and while he played with his children. Most people are Bruno. They are bucket carriers, doctors, lawyers, construction workers. If you stop working and your income stops, you are carrying buckets. Investing for passive income is about becoming Pablo. It is about building a pipeline. Now let's get real. In the financial world, building a pipeline isn't digging a ditch. It's allocating capital into assets that produce cash flow. But here is the disclaimer that most internet gurus won't tell you. Building the pipeline is hard work. Passive income is not no work. It is front-loaded work. You have to sacrifice consumption today, that new phone, that expensive car, to buy freedom tomorrow. So how do we build this pipeline? What are the materials? In the stock market and the financial world, we have 3 main engines, or materials, to build your passive income stream. We are going to explore each one in detail, including how they work, who they are for, and I'll share some specific case studies to make it concrete. The first, and perhaps the most famous engine, is dividend growth investing. When you buy a stock, you usually hope the price goes up so you can sell it later to a greater fool. That's called capital gains. But dividend investing is different. You are buying a piece of a business, and because you are an owner, you are entitled to a share of the profits. These companies pay you cash directly into your brokerage account, usually every quarter. I want you to imagine a guy named Michael. Let's call this our first case study. Michael is 30 years old. He works as a software engineer. He is smart, but he is risk-averse. He doesn't want to watch charts all day. He doesn't care about the latest meme stock or cryptocurrency that jumps 50% in an hour and crashes the next. Michael wants stability. He wants to sleep well at night. Michael decides to follow the dividend aristocrats strategy. These are companies in the S&P 500 that have increased their dividend payouts for at least 25 consecutive years. We are talking about boring companies. Companies that sell toothpaste, soda, toilet paper, and insurance. The stuff people buy even during a recession. Michael starts with $10,000. He buys a basket of these boring companies. In year 1, let's say the average dividend yield is 3%. He earns $300 in passive income. That's it. Just $300 for the whole year. It sounds pathetic, right? Bruno, the bucket carrier, would laugh at him. $300 can't even pay for a weekend getaway. But Michael knows the secret. He understands the snowball effect. He doesn't spend the 300. He uses a DRIP, a dividend reinvestment plan. That 300 automatically buys more shares of the same companies. Now here is where the magic happens. In year two things happen. First, because he has more shares, he gets more dividends. Second, the companies themselves raise their dividend per share because they are profitable, growing businesses. This is the double compound effect. Fast forward 20 years. Michael is now 50. He has been adding money to this pot every month, and he has never touched the dividends. That initial trickle of 300 has turned into a roaring river. His portfolio might now be generating 30,000, 40,000, or 50,000 a year in pure cash flow. And the best part, the stock market could crash tomorrow. Prices could drop by 50%, but Michael doesn't care. Why? Because he doesn't need to sell the shares to pay his bills. He just spends the dividends. He owns the golden goose and he lives off the eggs. He never, ever has to kill the goose. That is the power of dividend growth investing. It is psychological safety. It turns the stock market from a casino into a landlord relationship where you just collect the rent. Speaking of landlords, let's move to our second engine, real estate investment trusts, or REITs. Many people love the idea of real estate. They want mailbox money. They want to see a physical building and say, I own that. But let's be honest, being a landlord is a job. It is a stress test. Toilets break at 2 a.m. Tenants don't pay rent. Roofs leak during storms. That is not passive income. That is a second job with high liability. Enter the REIT. REIT. A REIT is a company that owns, operates, or finances income-producing real estate. They are modeled after mutual funds. When you buy a share of a REIT, you are buying a slice of their property portfolio. And by law, in exchange for not paying corporate income tax, they must distribute at least 90% of their taxable income to shareholders. That's you in the form of dividends. Let's look at a case study of a different investor. Let's call her Sarah. Sarah loves real estate, but she lives in an expensive city, maybe New York or London, where she can't afford a down payment for an apartment. She also has a demanding full-time job and no time to fix leaks. Sarah decides to build a REIT portfolio, but she doesn't just buy generic real estate. She plays the trends of the future. She diversifies across sectors. First, she buys a data center REIT. Think about it. Every time you send an email, stream a movie, post a photo on Instagram, or use the cloud, that data lives in a physical building with servers. It's not in the sky, it's in a building. The companies renting that space, Amazon, Google, Microsoft, pay rent to the REIT. Sarah gets a cut of that rent. Second, she buys a healthcare REIT. These companies own hospitals, nursing homes, and medical office buildings. As the global population ages, the demand for healthcare facilities goes up. It's recession resistant. People get sick whether the economy is good or bad. Third, she buys an industrial REIT. These own the massive warehouses used by e-commerce giants. Every time someone orders a package online, it moves through a warehouse owned by her REIT. Sarah is essentially a landlord of the modern economy. She owns hospitals, server farms, and logistics hubs. And the yield on REITs is typically higher than regular stocks, often ranging from 4% to 7% or even higher. The downside, REITs are taxed differently, usually as ordinary income, not the lower capital gains rate, and they are sensitive to interest rates. When interest rates go up, REIT prices often go down because borrowing money becomes expensive for them. But for Sarah, who is looking for income to replace her salary, REITs are a powerful engine. Now let's pivot to the third engine. This is for the ultra-conservative investor, or perhaps someone who is already wealthy and wants to preserve capital. We are talking about fixed income and bonds. For a long time, bonds were considered dead money because interest rates were near zero, but the economic landscape changes. When you buy a bond, whether it's a government treasury bond or a corporate bond, you are essentially becoming the bank. You lend money to the government or a company like Apple or McDonald's. In return, they promise to pay you back the principal after a set time, plus interest payments along the way, known as coupons. Let's imagine an older couple, Robert and Linda. They are retired. They have a nest egg of $1 million. They are terrified of a stock market crash wiping out 30% of their retirement in 1 year. They don't need growth anymore. They need certainty. They build a bond ladder. This is a sophisticated strategy where you buy bonds that mature at different times. Some mature in 1 year, some in 3 years, some in 5 years, and some in 10 years. Every 6 months, they collect their interest payments. It's reliable. It's predictable. If the stock market crashes, their bonds usually hold steady or even go up in value as investors flee to safety. While bonds might not make you rich fast, they keep you rich. They are the shock absorbers of your passive income vehicle. Now there is a fourth strategy that combines everything. It is popular in the FIRE movement, financial independence, retire early. It's called the total return or the 4% rule strategy. This strategy challenges the idea that you need cash flow or dividends. It argues that money is money. Whether you get 1,000 from a dividend or 1,000 from selling a small sliver of your shares, it's the same math. Let's look at a younger investor named Alex. Alex buys a low-cost total market index fund. He owns the entire haystack, thousands of companies. He doesn't care about dividends. In fact, he prefers companies that don't pay dividends, like Google or Amazon, because he wants them to reinvest that money to grow the stock price. Alex's plan is simple but bold. He builds a large portfolio. Once he retires, he sells 4% of his portfolio every year to live on. History suggests that the stock market grows about 7% to 10% per year on average, after inflation. So if Alex withdraws 4%, the remaining 96% continues to grow. Ideally, he never runs out of money. This approach is tax efficient because you control when you sell, but it requires a strong stomach. Imagine retiring and the next day the market drops 20%. You still have to sell shares to eat, which means you are selling low. That is the risk specifically known as sequence of returns risk. It is the nightmare scenario for the 4% rule. So we have covered dividend growth, REITs, bonds, and the 4% rule, but I cannot let you leave without discussing the dark side, the traps, the things that will kill your passive income dreams. Trap number 1, the yield trap. You will see stocks or funds advertising massive yields, 12%, 15%, even 20%. You might think, wow, this is the fast lane, I can retire in 3 years. Stop. Usually when a yield is that high, it's a scream for help. The share price has collapsed because the business is dying, making the yield look mathematically high, or they are paying out more money than they make, which is unsustainable. They will eventually cut the dividend and the stock price will crash. Never chase yield blindly. If it looks too good to be true, it is. Trap number 2, inflation. If your passive income stays flat, let's say you earn $2,000 a month fixed, but the cost of bread, gas, and rent goes up by 3% every year, you are actually becoming poorer. This is why dividend growth is so important. You need your income to grow faster than inflation. You need companies that have pricing power. So, bringing this all together, what is the roadmap for you listening right now? Step 1, the foundation. Before you invest a dime, you need an emergency fund. You cannot be a passive investor if you're forced to sell your assets when your car breaks down. Step 2, choose your engine. Are you like Michael? Do you want to see cash hitting your account every quarter from blue-chip companies? Look into dividend aristocrats. Are you like Sarah? Do you believe in physical assets and the digital economy? Look into REITs. Are you like Robert and Linda? Do you need safety above all else? Look at bonds. Or are you like Alex? Do you want total market growth and are willing to sell shares later? Look at broad index funds. Most successful investors actually use a combination. They might have a core of index funds for growth, a slice of REITs for diversification, and a layer of dividend stocks for motivation. Because that is the final secret, psychology. The hardest part of passive income isn't the math. The math is 5th grade level. The hardest part is the behavior. It's watching your friends buy new cars while you buy more shares of a boring utility company. It's watching the market drop 20% and not selling in a panic, but actually buying more because stocks are on sale. It takes time to build the pipeline. In the beginning, the flow of water, the money will be a drip, drip, drip. It will feel insignificant. You will question if it's worth it, but you have to trust the process. You have to keep digging. You have to keep laying the pipe. Because one day you will wake up and that drip will have turned into a stream, and that stream into a river. And on that day, you will realize that you didn't just buy stocks, you bought your life back. To wrap up this extensive guide, let's summarize the key takeaways you learned today so you can walk away with clarity. 1. Passive income is not about doing nothing. It is about doing the work up front to build a system that pays you later. Remember the story of Pablo and the pipeline. Don't be a bucket carrier forever. 2. We discussed the 3 main engines. Dividend growth stocks allow you to partner with profitable companies. REITs allow you to become a real estate mogul without the headaches of tenants. And bonds provide stability and safety. 3. We learned about the 4% rule, which focuses on total portfolio growth rather than just income yield, suitable for those who want to capture the full growth of the economy. 4. We warned against yield traps. High returns often carry hidden risks. Always look for the sustainability of the payout, not just the percentage. And finally, the magic ingredient is time. Compound interest needs time to work. The earlier you start, the less you have to contribute to reach the same goal. I hope this deep dive has given you clarity. Creating passive income isn't a get-rich-quick scheme. It is a get-free-eventually plan. It's accessible to anyone with patience, discipline, and a willingness to learn. If you found value in today's episode, please do me a massive favor. Hit that like button, subscribe to the channel, and share this episode with just one friend who is stuck carrying buckets. Your support helps us grow and reach more people who need financial freedom. Thank you for spending this time with me on Monster Invest. Now stop trading all your time for money. Go out there and start building your pipeline. I'm Daniel, and I'll see you in the next episode.